Hello and welcome to the November 2024 Opening the Gates market update. And we have a lot to cover in this recording. There's been so much going on in the market, both internally, externally, since I recorded the October market update. And I've been here, there, and everywhere in the past few weeks as well. So lots to be reporting back on. So I'm going to jump straight into it and start sharing my screen. As always, we're going to be starting with the Open the Gates market update. So let me just zoom out on this. There we go. Right. Okay. So as always, starting with left to right, left-hand column is comparing November to the previous month of October. We've then got middle column comparing November to the previous November, and then we've got the 6-year average on the right-hand side. So to start with, on the market, aka properties for sale, there was a reduction in number of properties actively for sale compared to October, which is unsurprising. It's a seasonal thing. There's less properties coming to market, as you can see, with an 18% reduction on October. But actually, if you look at November compared to the previous November, there's more properties for sale, more new listings, and more sales agreed. So you do expect a seasonal drop off in pricing, in number of properties available, new listings, sales agreed. But compared to last year, definitely still much more strength in the market and resilience. Again, I know I would have said it in the previous video update, but this time last year, we're in a struggle with the peak of interest rates. So it's more of a recovery and resilience as opposed to unbelievable growth in the market. However, if we compare it to the 6-year average for November, 6% up on new listings, almost 6% up on sales agreed. So clearly is a supply demand balance there, which is good news. That combined with higher interest rates is keeping prices in check. But there is 18% more property available, and we're at a 10-year high for number of properties available. So sellers do need to bear in mind there is a lot more competition. And what buyers can bear in mind is there's a lot more choice for them. And because of more choice for them, more competition for sellers, that means that they can probably get a little bit of a discount on the asking price, which I'll come on to shortly as well. If we go down to price reductions, number of price reductions down 19% on the month before. Again, unsurprising, it's a seasonal thing, but they are still 10.5% up on last year and almost 27% up on the 6-year average. Couple of things there. If I'm a glass half full, that means that sellers are realigning expectations and adjusting their prices following sensible estate agent advice, or the glass half empty is that sellers and estate agents are overvaluing or having higher expectations initially when they're listing a property. I think there's an argument for both, but I'm typically leaning towards the overvaluation side in the first instance. Again, being glass half full, withdrawn numbers are significantly down, which means that properties are selling, which is good, or sellers are more realistic in their pricing, adjusting their prices rather than just coming off the market. And I think we've got more serious sellers in the market as well, rather than ones who are just in it for a bit of fun and seeing if they can get a crazy price. In terms of fall throughs, we're almost 10% down on last month. That's because there's less sales being agreed. Fall throughs are significantly up on last year. And they are up on the 6-year average. So something just to monitor. I know I bang on about it a lot, but 100% check reservation agreements with Gazille. Time on market is also an issue because the longer a property is on the market, the more likely it is to fall through. The longer a sale goes on, the more likely it is to fall through. And I would recommend taking a look at OpenMove. So shout out to Ross McKenzie, co-founder of OpenMove. That's going live on the 12th of December. I'm going to be at the launch event for that in Cardiff, which I'm really, really looking forward to. That really, I do think, has potential to be a game changer, as cringy as it is, but I've just used that word in the market in terms of trying to collaborate with all parties involved in the process. So watch your space with that. And then relisting. So following the budget, we've seen an increase in number of properties re-entering the market, significantly higher compared to last year and slightly up on the 6-year average. So for anyone watching this, we're at the end of 2024, going to 2025. I 100% recommend you look back at properties that have withdrawn from the market in the past with yourself. Go back, have a conversation with them. Because according to 20-year inspect, around 50% of those will come back to market for a year or two. And then those that have withdrawn from other agents do go and target those as well. One of my friends has come up to a 6 month anniversary having been withdrawn from the market. They've recently received two letters from agents which were absolutely abysmal. One was very patronizing, which they're not going to give them their business. And the other one, literally in the withdrawn letter, said, "We'll do you a 0.5% fee," which is absolutely crazy, just off the bat on a withdrawn letter. So if anyone watching this needs help with content when targeting withdrawn properties, please do give me a shout, because there is definitely an art and a science to it, to get through more doors. And the trouble is, the more prospecting systems there are out there, it's easier for estate agents to just click and send withdrawn letters. If everyone's going to be getting 10 letters when they withdraw, and then another 10 after 3 months, 6 months, 12 months, and so on, you've got to be doing some bits to stand out. So please do reach out to me if you want to know more about that. Right, on to average asking prices and pounds per square foot of new listings. So we're up on last year, so currently standing at 408 and a half compared to 398 last year. So what's that, about a 2.5% rise? It has dropped down on last month. You'll see from the Rightmove statistics for asking price on new listings have dropped more significantly than usual at this time of year, but you would expect a seasonal drop off, comparing November to October. Average pounds per square foot is up. What are we looking at? About 10% on last year, which is very interesting to see. And then on sales agreed, we're up on last year, by about coming up to 5%, and we're just a little bit down on last month as well. 5%, probably closest to 2.5% again there. But again, we're looking at strong price growth, considering the amount of property available and where interest rates have been. Just goes to show that interest rates averaging mid fours to late fours is a sign of price growth. I think when average rates are closer to 6% than they are 5%, that's when you start to get negative price growth, as we saw in 2023. And then pounds per square foot currently sitting at 349. Again, I think that's probably about a 5% uplift. They're actually interestingly slightly up on last month. So prices seem to be in a very, very good place. And again, when I go through the multiple indexes and stats that I have, you'll notice that price growth is certainly on the up. But that doesn't mean that sellers can just start asking crazy money, because as we saw earlier, those that are asking far, far too much money end up price reducing. So net mortgage approvals. Now I've got my notes with me down here. Some unbelievable figures on net mortgage approvals. So hopefully I can get this all right. Where are we? So net mortgage approvals are up a staggering 42.5% on October last year, which is unbelievable. 4% up on September, and they've gone up 5 months in a row. So some really, really strong growth there in mortgage approvals, and mortgage approvals are a predictor of what the market is to be in several months' time, whereas transactions below will give you a lag on where the market has been. So in terms of transactions, October 2024, they hit 100,000 seasonally adjusted. I think for the first time since August 22. They've gone up 2 months in a row now, which is a positive sign. They're 21% up on October 2023 and are up 10% on September 2024. And then a real positive sign is they're actually up 3.25% on the 10-year average for November. So again, really positive signs there for mortgage approvals and transaction numbers as we move through the market. Now, just whilst I'm on this screen, I'm going to be looking at my second screen, which you're not going to be able to see, but just wanted to report on some things following Roger Martin Fagg speaking at the RAN conference on Friday. So huge shout out to Simon Well for putting on that event. So in terms of what Roger had to say, really interestingly, his outlook for property prices, he said we're at the bottom of the housing cycle, and he believes that we're going to hit the peak of it between 2029 and 2032. So we should see a 5-year price growth. The cost of a 5-year fixed rate mortgage today is only 0.3% higher compared to 20 years ago. So let that just sink in. And then quite interestingly, I've seen this on a few things, but from 2026, restrictions on the amount banks can lend will be reduced, which is good to hear. And the bottom of the end of his presentation said, "Get ready for the boom." So he certainly has a positive outlook. Now, in terms of forecast for the end of 2025, he said that inflation will be around 3%, earning growth at 4.5%. He believes the base rate, sorry, I believe interest rates will be around 4.75%, so not much lower than where they are now. House price growth of 6%, which is one of the highest predictions I've seen, which is very interesting. Unemployment to be at 4%, which is pretty much where it is now. So yeah, some very, very strong predictions coming out from Roger. And I had the pleasure of meeting him as well. Very fascinating bloke. Really knows his stuff when it comes to the economy, and the amount of predictions he gets right is just absolutely mind blowing. So do go check Roger Martin Fag out if you've never seen his stuff before or seen him speak. What I am also going to report on from my other screen, just whilst I've got it open. Um, so where are we looking? So I've got a Lloyd's Bank Market Insight. So Lloyd's being the largest lender in the country. So the Bank of England's governor, Mr. Bailey, has remarked that he expects four base rate cuts in 2025, bringing the base rate down to about 3.75% by the end of next year. And at the time of writing this, the markets are pricing in 75 basis point cuts by the end of 2025, which, yeah, would bring us to about 4%. Um, so yeah, we're looking positive. We're not going to see mass rate cuts, but I think a lot of people still hope will happen before they enter the market. We're not far off where normal rates are going to be now, which are pretty normal by long-term standards anyway. In terms of average current mortgage rates, so this is from Rightmove figures. They're saying the average rate on a 2-year fix is 5.08. And that's about 0.41% down on a year ago. And the 5-year fixed rate currently sits at 4.85, which is 0.22% down on a year ago. Again, the fact that 5-year fixed rates are still slightly lower than a 2-year fixed rate shows that the markets believe there is still some movement downwards. You would typically find a 5-year fixed rate being more expensive than a 2-year fixed rate. Now, the lowest rates for 2 years and 5 years rates, so 2-year fixed rate lowest currently is 4.22. That's a yearly change of 0.43% drop. And then the 5-year fixed rate currently sitting at 4.10%, and that's a yearly drop of 0.19%. So again, really, really good data there in terms of what's happening to stock levels, new listings, sales agreed, interest rates, transaction levels, predictions, all very positive there. So going to move on to the Rightmove House Price Index. So Rightmove have reported the monthly average asking price decrease of 1.4%, larger than usual November drop. Annual price change is still in line with their end of year prediction of 1%, and increase in buyer demand versus a year ago, following the post bank rate cut uptick of 23%. So yeah, since I recorded the last one, we have had a budget, we've had a base rate cut, we have had Donald Trump get elected, we have had inflation go up. There's a really great word I learned recently from Royston Guest at Perry Power and Royston Guest boot camp last month, and it was permacrisis. Basically, we are now just in an ever ongoing state of crisis, where war, economy, inflation, interest rates, you're never more than a day away, a week away from some sort of headline that could impact the markets. And I think that's why we've just seen such resilience in the property market in recent years. I think as well, the amount of equity, so money held in property in this country, means that the government really need the property market to continue going, because it has such an impact on the overall economy as well. So in terms of the Rightmove House Price Index, what else did I learn from this? They believe that there is going to be a 4% rise in 2025. That's their highest prediction since 2021. Seller competition is its highest for 10 years in terms of stock levels. I've obviously spoken about that a lot before. And there's been 2 months in a row of asking price drops. Again, that's been more normal, more than usual. There's been a lot of news to digest, which I've just kind of said in terms of the perma crisis. But new sellers are up 6%, sales demand up 26%. So there's really, really positive signs there again from Rightmove, albeit, yes, there is some price drops in asking prices. It's normal for seasonal uh, time of the year that we're at. Um, but yeah, all kind of positive sort of things there. I think they say about affordability stretch, which is an important bit again. So whilst interest rates have dropped, there is still a stretch on affordability, and I'll come on to some more bits on Zoopla on that as well. Now, if I scroll down here as well, um, we look at average stock per agent currently sitting at 63. Get Agent reported in the media the other day that about 45% of all properties currently on the market are sold subject to contract. So that would basically mean the average agent has 28 units in their pipeline for sale at the moment. If we go by those stats. And then time to agree a sale currently sits at 62 days. The latest data from Rightmove is 151 days to go from sale agreed to completion. That's 213 days to complete from new instruction to completion. So again, I would have said this a lot in the past, but please, please, please do educate buyers and sellers on that information. There's some really interesting data actually that came out from Hamptons, which I'm just going to look at on my other screen. So in terms of completion times, the chance for sale agreed in December reaching completion before April, obviously stamp duty deadline, is literally close to a coin flip. Historic data suggests that around 71% of all sales agreed in November will complete before April next year. However, sales that are part of long chains or where management companies are slow to respond to inquiries are now likely to incur higher stamp duty bills. That's really interesting here as well. Only just over half of flat purchases, 55%, are likely to complete before the stamp duty deadline. Apparently, the average flat sale takes 39 days longer to reach completion compared to a house. So again, if you're selling plenty of apartments, I think that's something very interesting to know, and why to get your sellers ready with management packs and getting legally ready at the start. And then they go on to say historically, just 37% of purchases agreed in January would go on to complete by April of the same year. They tend to be the cash purchases where the buyer is able to proceed quickly. So really needing to get this message across around the stamp duty deadline. I think all the reports are indicating we should have a very, very strong first quarter in 2025 as people try and beat the stamp duty deadline. Q2 might be a little bit quieter because of the hangover, let's say, from that stamp duty deadline, should I say. But it should breed a lot of activity. Yes, there's going to be people buying and selling or trying to in the coming months who won't hit the deadline, but once they've got skin in the game and they're excited about moving or they're financially committed, I'm sure that will help the transaction levels, along with hopefully interest rates coming down a little bit more as well. So with Rightmove in mind as well, it's always this time of year where we tend to talk about Boxing Day launch. Should it or should it not be a thing? Initially, my thoughts on this are do what's right for the seller. If they want to put it on, let them put it on. But the whole Boxing Day bounce thing, is it more of a corporate ploy to win more listings or get price reductions down? I think it's not a Boxing Day boom, it's Boxing Day sales, in my opinion. I've looked at the last 5 years, and around 42% of new Rightmove alerts that go out between Christmas and New Year's are price reductions. So for me personally, if I was looking to list my house, I would be listing it now at the time of recording. So this is Sunday, the 8th of December, or I'd be looking to do it in January. So if you look at the infographic on the screen now from 2022, December 22, January 23, Rightmove traffic, you'll see that just before Christmas and a few days leading up to it, when we all do our last minute Christmas shopping, or at least I do, the traffic drops significantly. And when Rightmove report a busy Boxing Day, that's because they're comparing it to the Christmas day, which you'd hope to think people are not on Rightmove, they're spending time with their loved ones. Interestingly, there was a 69% increase in visits in the second week of January versus the first week of December. So again, I would either be listing it now or I'd be listing it in January. And quite interestingly, data came out from Zoopla the other day to say January 2024. That was the busiest month of this year, followed by February and March for traffic. So again, if sellers are wanting to attract buyers, get your property on the market sooner rather than later. And if you are going to do a Boxing Day launch, again, just thinking out loud, if I was an agent again, do not disturb campaigns, for example. So saying, look, let's launch it around Christmas time, put some videos out, some sneak peeks, some pre-launches, and say, book in for an open day come January. Try and get lots of interest across social media, but don't launch it until that January period, so you don't have that date just plastered on it. So I hope that all makes sense there. Just thought I'd share that on the Boxing Day side of things. Right, on to Zoopla. I've got a bonus bit on Zoopla here because I was fortunate enough to attend the Negotiator Conference, and Richard Donnell has very kindly shared his slides with me, which I'm going to run through with you. So Zoopla have seen a 1.5% year-on-year house price increase. They expect 2.5% increase in 2025, and they're expecting 1.15 million transactions in 2025 as well, which is a pretty positive market. It's not the amazing market of 21, 22 transaction levels, but certainly there's sales to be had there for agents up and down the country. So in terms of the market, buyer demand up 24%, sales agreed at 19%, which outstrips new supply at 15%, and stock of homes for sale is up 10% year on year, according to Zoopla. Now, in terms of the housing market returning to growth this year, that's been supported by rising incomes and lower mortgage rates. In terms of mortgage rates, they say here, the last bullet point, they're unlikely to change over 2025. And they're expecting lenders to innovate affordability assessments, supporting demand. I think I touched on that earlier as well. So if we scroll down to here, as you can see, return to real income growth helps repair housing affordability. And that is predicted or projected to continue from the Office for Budget and Responsibility over the next few years as well. So some real positive signs there in the market. Now, this is really, really interesting in my opinion. The increase of home buyers rise as purchase price fall. So first-time buyers, their purchase price has dropped by about 0.1%. Mortgage size has increased by 2%. Their household income has increased by 12%. Now, quite interestingly, people who already own a home, what they have done is to help them purchase their next property. Yes, their household income has gone up, but because of higher interest rates than they've been paying in recent years, their purchase prices are reduced by 3%, their mortgage size is reduced by 6%. So this is a clear sign to sellers. Buyer demand is there, but if you do not price competitively, sensitively, these cost conscious, value seeking buyers will just go find something that gives them more value for money. They're not stretching like they have done in recent years. I think it's really, really interesting information there from Zoopla, and certainly something I'd be talking about with sellers. So as you'll see, mortgage rates hold steady, and Zoopla do a really interesting measure of UK house prices on whether they're undervalued or overvalued. As you can see, late 80s massively overvalued. We then had the GFC in 08, massively overvalued, and with where house prices are now compared to affordability, they're actually in a pretty steady state. Bearing in mind you do have the deposit to put down on it. So housing affordability has improved over 2024 with rates coming down, with income improving, and the growth we had through 22 was evaporated in 23, or it has returned a bit in 24 with some growth as well. So their last paragraph here, looking forward, they expect UK house prices to remain undervalued over 2025. That's assuming a mortgage rate of 4.25%, house prices going up 2.5%, and income growth of 4.5%. In the 3 years, to the end of 2027, they expect house prices to grow by about 7.5% in total. So, still got a few more tabs to go through, but reading what I've read so far, I don't know about anyone watching, but this says to me, anyone sat on the fence waiting for rates to come down, house prices to come down, it does not look like that is going to happen. So, if you can make a move, if you want to make a move, maybe just get on with it. I appreciate that's a very blunt statement from me, but the amount of times I have conversations with people who are like, oh, I don't know if now is the right time to move. If it's the right time, if you can afford to do it, do it. You got to remember it's a home as well as wanting to have it as an investment for the future as well in terms of getting some equity in it. Um, Stamp duty. So I've touched on this a little bit already, but number of first-time buyers who are going to be paying stamp duty from April 25 is going to double, and then the number of existing homeowners that will pay stamp duty is going to increase from 49% to 83%. So again, this is perhaps going to impact on affordability. And again, these cost-conscious buyers are perhaps going to factor that into their budgets. Just like if I scroll up, where were we? Just like here, in terms of reducing purchase size and mortgage size here for the existing homeowners, maybe that's going to be increasing a little bit more as well when they factor in the stamp duty costs. Now, what's quite interesting though is I'm going to come on to this later, I think, with Halifax, but they found that increase in buyer demand actually was already happening before the budget. So it's more to do with improving interest rates as opposed to a stamp duty deadline looming. So again, we've had stamp duty changes in the past, and has it massively impacted the market? Not as much as we perhaps thought it would. And without getting all political on that, because I think there should be different stamp duty incentives in place. Looks again from the affordability point of view, a number of properties available, but following a slight hangover after the deadline on 1st of April, we should still see positive transaction levels of around 1.15 million in 2025. And funny enough, as I say that, onto the next slide, Zoopla saying 1.15 million sales in 2025. And you can see how, let me just zoom in on this, how that kind of compares to previous years. So yes, we've had the booms, kind of early noughties in the 80s, and then the pandemic boom as well. But that's going to be 5% higher in 2024. And it's going to be 10% higher in 2023. Interestingly, pipeline of sales is also 30% larger right now than it was this time last year. So that is definitely going to support some completions and deliver a boost in the first half of 2025. Again, they say the key question is whether that current momentum in sales will continue throughout 2025. I believe that momentum will continue because of improving conditions and the fact that people just seem to be in a mood of let's just get on with it as well. So as long as there's no black swan events worldwide that could impact things, I think that again, if you look at the last paragraph, an aging population, rising running costs, and changing working patterns will continue to impact moving decisions. In addition to desire to seek a better home or location. Now, interestingly, Roger Martin Fagg said at the RAN conference that people in the 30 to 35 year age bracket is going to peak over the next few years. If I just look back to my notes, yeah, next 5 years. Now, for me, that is prime first time buyer territory. Typical first time buyer is around that sort of early to mid 30s. First time buyer are the most common most common buyer type in the country. If that's going to be peaking in the next 5 years, that means there will be more first time buyers, and we need first time buyers in the market to support market activity. And I think that is just a really, really good sign there. The aging population as well are downsizing, they're releasing money. Bank of mum and dad, bank of grandparents who are gifting to these first time buyers who are then getting onto property ladder. And as rents continue to rise, these people who are in rented will want to go buy somewhere, so they're paying their own mortgage rather than their landlords. So just a few sort of economic basic points there from me as well. So the summary from Zoopla, as I say, very resilient in the face of higher borrowing costs over the last 2 years, but higher income growth and mortgage rates around 4% have definitely helped repair affordability. They're expecting house price growth of 2.5% in 2025, and then sales agreed ending 5% higher next year and 10% higher than 2023. First time buyers, as I've already said, will remain a really important buyer group. Existing homeowners will need support because it's where they have been impacted most in terms of higher mortgage costs. So that sort of middle part of the market really does need some help. What can be done there? I think if I had the answer to that question, I would be an incredibly rich man. So the bonus part of this update, which I'm really excited to share, was from Richard Donald's presentation at the Negotiator Conference. I'm going to seek forgiveness rather than permission in terms of sharing this, but it's some super, super useful information. So some of it I've kind of already gone through, but some of it will be new information as well. So sales volumes edge 5% higher this year, and house price inflation up 2.5%. We know that. Strong sales pipeline is 30% up on last year, which is going to carry into 2025. as you can see from this graph. And then sales inventory, so number of properties available, highest it's been for 7 years, according to Zoopla. Other sources would say decade. They're saying around about 12% of landlords are selling up, or are on the market, should I say. Half of those properties will end up back in the rental market, because they are sold to other landlords, or they fail to sell and they end up being rented back out. But there is definitely more properties for sale, as I've said earlier. As I've already highlighted, first-time buyers account for 36% of sales, so the biggest buying group there is. As you can see, existing owners with mortgages has reduced compared to 20-year average as affordability stretches have hit them the hardest. Now, 43% want to move out of area. Is that because they're wanting to go to a more affordable area? So again, any agents watching this, if you're not already offering search and secure or onward negotiation, I strongly recommend you do it. If you want to find out more about that, go check out Perry Power on it, because he's the absolute goat when it comes to that kind of thing. And you can also speak to me on it as well, because if you're part of a network as well, for example, things like the FIA or RAN or the Guild, you could potentially be earning referral fees from being part of a network by passing it on to another agent if there are valuation leads in other areas. And then the buy to let market, interestingly, has reduced a little bit on the 20-year average, but still 7% of transactions are with a buy to let mortgage. So if you are finding your landlords are wanting to sell, find your other landlords who are wanting to buy, or find landlords out there that want to buy property, then hopefully you're not going to be losing that stock. And then also, as I've just kind of said, go and find the landlords that want to buy new properties, offer them a sourcing service, offer them a negotiation service, offer them that you'll manage their property if you find somewhere for them. In terms of the state of the market for landlords, if anyone wants to find out more information on the 2024 private landlord survey, please do reach out to me and I'll send you a link to that. There's some incredible data in there that could certainly help you in 2025 in terms of the rental market. House prices return to growth on lower mortgage rates. So as I said earlier, mortgage rates being in the sort of mid to high fours has shown that house price growth will happen. And the closer they were to 6% meant that there was a reduction in house prices. Apparently, according to Zoopla, it's still a buyer's market, but agreed sales prices are firming. So on average, an estate agent is achieving approximately 97% of the initial asking price. Again, if you know your numbers inside out, which you should do, you should be measuring that. So, for example, if you're achieving 99.1%, you're getting 2% more than the average agent. Average UK house price at 300 grand means that you're 6 grand better off. So, even if your fee is £2,000 or £3,000 more than the other agent, you're more likely to get a seller extra money in their back pocket. So certainly have a look at that. If you want to know more about tracking your numbers and what metrics to measure in terms of showing why you are the best choice, again, please do reach out to me. I'll happily share some more data with you on that. First time buyer affordability, renting versus buying, as you can see from this graph. If we just concentrate on the UK as a whole, again, if you can afford to buy, you've got the deposit, you can afford the mortgage repayments, you are better off buying a property than you are renting somewhere out and paying your own mortgage rather than a landlord's. We've already run through this, but more buyers are going to be paying stamp duty from April 2025. So that's certainly a message you want to be putting out there at the moment. And don't be afraid to put that message out there. Some agents might be thinking might be a bit of a negative headline. Tell people what is going on. Be completely transparent with the information. You want to be what am I trying to say here? Outlet of choice when it comes to property market updates and information, where your local market goes to you for updates rather than getting it from news outlets that perhaps are not telling them the truth, telling them what they want to hear and what's going to sell newspapers, for example. Right, this is really, really interesting data here now. So sellers who've been in their home an average of 7 years, on average, have made £60,000 increase in capital. Now you think of a mortgage they would have paid off in that time as well. Again, that's something to be reporting back. So I'd be going back through your database to people you've sold to in the past, your sellers who have bought through someone else locally, and any market appraisals you've done in recent years that haven't sold, and just saying, would they like to know what the equity is that they've increased in their home? Scan the QR code, click the link to get a home value report. So using instant val tools or things like Street Insights, for example, or you can send them a personalized home value report. It's a great way to leverage the database that you've already got. So again, that could be emails, that could be WhatsApps, that could be social media, that could be direct mail. There's loads of different ways to be doing that. And at this time of year, and as we go into January, people will be looking at their finances, maybe contemplating a move in 2025. Be that person in their letterbox, on their iPad, on their phone, in the conversation at the dinner table at Christmas. Again, you want to be the conduit of all information across those different media platforms so that they're thinking of you and speaking about you and then going and speaking to you when it comes to making these decisions. Interesting data again that I found from the likes of Zoopla, Get Agent, ValPal. I see a variety of these different tools bring out data highlighting that typically 20-25% of people are researching their home for several months in advance of coming to market. So don't just go after that 2 or 3% on the market right now. Think of those ones who are in research mode but not in sell mode. And that's where the gold is going to land because if you can get uncontested business, more likely to list that home, get it at the right price, get it at the right fee. If you're going in last minute of one of three agents, they're going to shop on price and they're going to shop on value. So they'll go to the agent who overvalues it and charge them a cheaper fee. So if you want more information, again, on how to target those people before they're thinking of moving, again, I'd love to have a conversation with anyone on that. So, in terms of prospecting for future sellers, it's an ongoing saying, isn't it? Today's buyers are tomorrow's sellers. There's a variety of different ways to do that. The people who buy through you then sell through you in the future, you would hope to think, but actually 86% of buyers don't sell through the estate agent they bought through. You can do VIP buyer campaigns because how many times over the years have we all heard the line, I'll sell through the estate agent I bought through. And there's some unbelievable information here. So highlighting the Goldilocks zone of people moving within a 3 to 7 year zone of buying their home. So I've been having this conversation a few times recently. I think a really undertapped market is the first time buyer market. Put loads of content out helping first time buyers buy their first home. Hopefully, they're then buying through you. They then sell through you in a few years. They then buy their next home through you. They sell that one because you basically buy your first home, typically move within a few years, and then move again. So there's probably going to be two moves in that first 10 years of owning a property. Whereas when we're just targeting the higher in the market, that's perhaps once in a generation sort of move. So as you can see here, there's a bit of a Goldilocks zone at sort of years 16 to 18 as well. So again, in terms of how to target these people, please do reach out to me. I'll happily help you with that. Another interesting point I've already kind of said about affiliated networks such as FIA, RAN, Guild, but around 59% of sellers or buyers, should I say, are looking in the area. Most of those people are going to have a house to sell. So again, tomorrow's sellers are today's buyers. Your buyers who are not yet on the market, because they won't put their house on the market until they help them find their next home. Now, for those 41% who are looking outside of area, again, there's referral opportunities there if you're part of a network. But also, if they're looking to buy out of area, but they own in your area, offer them a search and secure service or onward negotiation. There is so much money left on the table for estate agents where they could increase their average order value. Again, shout out to Royce and Guest for that kind of language. And I think I've heard him say this, and maybe Tom Panos. It's like, for example, taking someone to the airport who's going away on a holiday and not asking them, do you need a lift back when you come home? You take them halfway there. Why you're not doing the other 50%? There's so much money, and the amount of agents that complain about lower fees. If you can increase your value proposition, you can increase the amount of money you charge, and people do not realize they need it. Again, great language from Royce and Guest. People are silently begging to be led. So help them along the way. Show them that if they're moving once in a half a dozen years, a dozen years, 20 years, they need an expert on their side in their corner who's going to help them get the best outcome. So again, already reported on this, housing sales up 5% to 1.15 million in 2025, and not far off the long run average of the last 50 years of 1.2 million. So 1.2 million is a healthy market. We're just not that far off it. Again, if there's lower transaction volumes, you've got to try and increase your market share. Same time, increase what you're charging as well on the fee side of things. Again, if anyone wants any advice on fees, please do reach out to me on that. So a few bits on the lettings market. I tend not to speak about the lettings market too much, but I have a real interest in it and know the value to a business of having a decent lettings book. So I've already said about the private landlord survey from 2024 that came out a few days ago. Reach out to me if you want to see a copy of that and have a chat with me about it. But as you can see, the private rental sector stopped growing in 2016, coincided with the additional stamp duty coming in, and it's now consolidating. So you can see here that 50% of the stock is owned by 20% of landlords with five plus properties, which is crazy. A lot of those portfolio landlords have them in company names. That's continuing to increase. That's 100% again where the gold is. Now, 82%, I believe, of rented properties do not are not fully managed. That's where your gold is again. There's so many ways to prospect and lead gen for rented properties. And a huge shout out to Kieran Slinger and the team at Propol. What they're doing to attract landlords is unbelievable. So if you're not already using that system, I'd strongly recommend you go check it out. Now, really interesting here. So again, Zoopla said 12% of sellers are landlords looking to exit. Rightmove, I think, said it was about 18%. When I've done research, it varies from 10 to 20%. In London, it's considerably higher. But if you actually look at this, whilst there is some stress to landlords in terms of increased cost, legislation, tax, interest rates, etc., 38% do not have a mortgage on their property. 32% have a loan to value less than 50%. You then have 30% that have a loan to value higher than 50%. So it's that 30% which is your accidental landlord. And that's what I've seen from the 2024 survey. Those accidental type of landlords who have got higher interest rates now, they're the ones who are kind of exiting the market. But it's the ones who have got no mortgage or little mortgage who are staying or looking to increase their portfolio. As you can see, rental growth has continued to rise. Yields are looking pretty okay, and the maximum loan to value is averaging about 72% with a 76 grand deposit. Rental inventory continues to be significantly low, which is why rental prices have continued to rise. But demand is cooling with lower migration, softer jobs market, and then more tenants looking to be first-time buyers. I think that was it. Yeah. So summary on that. Private rental sector largely through the consolidation phase, but the growth in the professional market, actually a good thing for the market, to be fair. There's certainly enough price growth to support home moves because you need house price growth to increase equity to enable people to move. Because obviously, if they have negative equity, they're going to sit tight. I think a lot of people in the past year or two who would want to move maybe need to move haven't done so because of the extra increase in mortgage payments. And then the support for sales from hopefully innovation in lending, and then helping sellers find their next home. Again, I've spoken about this a lot before, but if you're not doing VIP buyer campaigns, do it. And if you want some really interesting videos, which is some great commentary from Rory Sutherland on the psychology of moving home, reach out to me and I'd happily share those with you as well on that. Right, okay. Hopefully come towards the end of this review now because I appreciate I've been rambling on a fair bit. Right, what have we got here? Nationwide. So Nationwide have reported fastest growth month on month since November 2022. They're 1% below the heights of November 2022. What else they say? Pre-pandemic mortgage application levels are now being seen. Household debts have reduced as well, and they're at a level not seen since the mid 2000s. And then if we look at the monthly and annual gains here, again, look at that from last year. Very positive on the monthly and annual, very, very positive. A 3.7% annual increase and 1.2% monthly. So Nationwide is certainly reporting some strong figures there. I think, what else do I want to say on this? So housing markets remained resilient. Number of mortgage approvals approaching levels seen pre-pandemic, as I said, despite the higher interest rate environment. Solid labour market conditions, low levels of unemployment, strong income gains, even after taking into account the inflation figures that we've had, have helped underpin a steady rise in activity and prices. And then, as I said, the balance sheets have been kind of at the lowest level since the mid 2000s. So the underlying strength of the market will be more difficult in the coming months as the upcoming stamp duty changes will provide an incentive for buyers to bring forward house purchases to avoid paying additional tax. So I would not want to be a conveyancer in the next few months, as that's going to be pretty crazy. Because we will expect a jump in transactions in the first few months of 25, as I've already said. But providing the economy continues to recover steadily, as is expected, the underlying pace of housing market activity should continue to strengthen gradually as those affordability constraints do ease for a combination of lower interest rates and earnings outpacing house price growth. So some really good data there from Nationwide. Again, if you're not already doing videos on this yourself, reporting blogs, doing some social media updates, using it in direct mail, I'd strongly recommend you do it. It can be brilliant. So a quick little thing for you that I do, it's hi-fi. So if you're doing content, is it helpful? Is it informative? Is it fun? Is it interesting? If you look at the hi-fi formula, that should certainly help you with your content. You've got AIDA as well. Get someone's attention, get their interest, create a desire, then have a call to action. So hi-fi and AIDA certainly look to follow those two principles. Right, on to Halifax. So they have reported a fifth consecutive month of house price growth, 4.8% up on an annual basis, and it was 1.3% for the month of November. That's the biggest rise this year, which is really, really good to see, and the strongest it's been since November 2022. Um, and then what else did they say? So latest figures continue to show improving levels of demand for mortgages, and an easing in mortgage rates has boosted buyer confidence. However, despite these positive trends, many potential buyers and movers still face significantly higher affordability challenges. So buyer confidence is tested, and as I showed earlier with the Zoopla index, buyers are just looking to buy cheaper properties. Basically, they still want to move; they're just adjusting their budgets. Sellers need to appreciate that. We move towards the end of this year and into 25. Again, positive employment figures, anticipated slight decreases in interest rates are expected to continue supporting the demand. And that should again be underpinned by further house price growth, but albeit modest growth as borrowing costs remain above average from few years ago, which will impact what people can afford. I think with Halifax as well, just on this, if I look at the top one here, the I've already reported on most of this, but transaction numbers quarterly from August to October were 3% higher than the preceding 3 months, which was May to July, which is good to see. And then the RICS survey continued to show improving market conditions. Sales agreed new buyer inquiries remain positive. New buyer inquiries recorded a net reading of 12%, its fourth consecutive positive monthly reading. And net sales agreed up 9% from 5%, with new instructions at 14%. So again, Rick's reporting some great figures as well. I think every so often I do share their insights, but because it was on Halifax, I've just chosen not to include it this time. Right, the house price index, average UK house price is 292,000, up 2.9% annually, and the monthly price change is 0.3%. Again, seasonally to be expected. But if we just look at house prices in general, if we look at the height of of September, October 22, it was 288 and a half. We're now currently sat at 292, and compared to last year where it was 280. So again, house prices have certainly moved in the right direction. Um, I've done the RIC survey, so I won't worry about that. Right, last couple of bits. Property Mark's Housing Insight Report. This was released in November, but it's for September. So the bit I wanted to share was here. So prospective buyer registrations from Property Mark members is at a 2-year high. So again, a sign of improving market conditions, bringing more buyers back to the market, which is good news. And then I wanted to look at this page here. So stock levels remain healthy, which is good. Market appraisals have dipped slightly. So again, if agents need help getting more appraisals, if I had a pound for every time someone said to me, I'm really good in the living room, it's just I need more living rooms to enter. Excuse the pun, but open the gates to more listings. So if you do want help with trying to win more appraisals, whether that's digital or analog marketing, please do reach out to me. Number of sales agreed has continued to increase according to Property Mark members, which is great. And then this was the last bit on Property Mark that I wanted to look at. So, if I read this rightly, around 80% of sales are below asking price. Around about 10% are at asking price, and around about 5% are above the asking price. Again, if I've read that correctly. So I would be measuring what percentage of your listings achieve the asking price, what percentage achieve below, what percentage go below 95%, below 90%. Because again, I've got some data from Zoopla on that. And if you can highlight when it comes to valuations, look, I'm valuing it at this, and this is my accuracy range. That will help when you're going up against agents who continuously overvalue. Right, last one on this, time taken to exchange contracts. So if I read this rightly, approximately 30% of sales are taking 17 weeks or more. Rightmove reports it's about 150-ish days from sale agreed to completion. This massively needs fixing. Again, there is data from one of my clients who's found that when sellers legally instruct at the start of the sale rather than waiting for 2 months to agree a sale, they're more likely to get through to completion and do it quicker. I think Ian Preston at Preston Baker has something called Property Launch that also backs this up as well. So you should be measuring when someone gets legally ready, when they choose a certain package, they're more likely to sell, do it quicker, get more money in their back pocket. I know I'm broken record in saying this, but if you want to discuss it further, please do reach out to me. And that's another plug for Ross McKenzie and what he's doing at OpenMove to try and help this broken process that hasn't changed in decades, if not centuries, when it comes to moving home. And then last but not least, home.co.uk. Let me just scroll back up here. So there's a few paragraphs on this that I wanted to run through. So UK property market continues to show renewed vitality. Property turnover is currently higher than during most of the last 10 years, and typical time in the market remains significantly lower than in pre-pandemic 19. Great news there. Such is the volume of property moving through the market that despite a large uptick in new instructions in October, the total of unsold property fell significantly over the same period. Again, good news. The total number of new instructions entering the market during October was 14% more than during October 23. So again, good news. The unsold sales stock count for England and Wales fell by just over 13,000 during last month. So there's about 495,000 properties currently on the market. And I think that leads me to say seasonal price dips were observed. As I said earlier, you expect it. But prices continue to rise in Scotland and the Northwest over last month, whilst in London they remained unchanged. So if I go down to page 4, sales market turnover indicator, this is highlighting again, look at where we were a couple of years ago to where we are now. Definitely more sales being agreed. You've then got the 5-year growth. So property prices in the last 5 years are up, according to home.co.uk, about 15 to 20%, which gives you that house price growth to enable people to move home as long as interest rates keep coming down slowly but surely. Total stock of property for sale is at a 10-year high. Again, I keep banging on about it, but not so high that it's causing an imbalance between supply and demand. We've got a very, very measured market at the moment between supply and demand, which to me is a good thing, and that is increasing confidence and boosting activity in the market. And then the last bit to look at is this map. So home.co.uk reporting a monthly drop of 0.3% on the average asking price, annual increase of 2%. And then in terms of time on market, average time on market is 172 days. Typical time market is 95 days, and an annualized supply change is about 14% more property. Just for the avoidance of doubt, what is the difference between average time on market and typical time on market? Down here, you'll see average is the mean days and typical is the median. So average being the total of everything, and then the median being the middle point between 50% lowest, quickest time to sell, sorry, shortest time on the market, get your words out, Simon, and then the 50% higher in terms of length of time in the market. So that brings my November UK property market update to a close. That has been a really long one. I feel like I was a bit all over the place with that, but it's so much to cover. Just leaves me to say, please do make sure you're liking, you're commenting, you're feeding back to me. Drop it a follow or hit the subscribe button. Trying to get myself to 100 subscribers by the end of the year, which would be totally awesome. From where I started this towards this, I think I started this in January, to be fair. And then yeah, I think we're in for a real positive 2025 for those who've done the work in 2024. And if you've enjoyed what you've watched in 2024, please do reach out to me. Always love having property conversations with people. And that just leaves me to say Merry Christmas and a Happy New Year, and I will see you in 2025.